Afternoon, everyone. Welcome to the Travel Vault webinar. So the eagle-eyed amongst you will have probably by now noticed that I'm not Christina Brazier. Unfortunately, Christina wasn't able to join us at fairly short notice. So I'm stepping in. I'm Martin Alcock from the Travel Trade Consultancy. Welcome to Amateur Hour. Thankfully, I've got Lucy on hand to walk me through and keep me on the straight and narrow. We've got two guests joining us today. And they're going to share some of their insights on what they're seeing at the moment. Firstly, we've got Adam Pennyfather. He's a colleague of mine at TTC. He runs our financial advisory practice. Adam's going to give us his latest views on what he's seeing amongst his clients, as well as talk a little bit about the latest from the government on the various support schemes. Adam's obviously fairly well known to you guys on this webinar because he's been on quite a few times before. The second person we've got joining us is Steve Sherry, who's a partner at PwC, and he's in the business restructuring team. Steve's going to come and share his advice, really, and experience on a whole range of matters, and just explain a bit more about what that business restructuring team gets involved in. That's going to cover things like restructuring work, refinancing, and working with lenders and stakeholders and that sort of thing, as well as advice on managing through difficult situations. And we'll certainly touch on the insolvency process and his work on a handful of travel companies' insolvency processes that he's worked through. Really, this business restructuring and recovery area is something that I know is certainly it's of interest to a lot of Travel Vault members. I know when Travel Vault have asked for subject matter, it's something that routinely comes up. Just before we get into the detail, just a couple of housekeeping points. Firstly, we'll keep all the attendees muted, really just to help with the sound quality, but very, very happy to take any questions on any aspect of what we talk about. If you could please just submit them through the Q&A function at the bottom of your screen there, and avoid putting any questions in the chat, just so mainly we can keep them all in one place, but also because I'm terrible at multitasking. Just also on questions, look, I appreciate some of the stuff around restructuring we might get into where the questions maybe are a bit sensitive. Firstly, just want to say up front, any questions we do get will be totally anonymous, certainly when we're sort of reading those questions out. Secondly, though, if you'd rather not ask a question right now live on the webinar, feel free to submit them later and we'll make sure they get answered. Either you can send them to Lucy, who would have sent you out the link to join today, or you can send them to me directly. Second point to note is the webinar is being recorded. It will be available within a day or so on our YouTube channel. Obviously, we'll edit out any sort of mistakes and try and make it look nice and professional so that when Christina sees it, she doesn't have a fit. Just, I suppose, on the housekeeping front as well, just to let you know that the following Travel Vault webinar will be on the 12th of November. And we've got a guest there, Andy Freeth, lined up, well-known figure in the travel industry. So you might well have come across him before. He was the managing director at Travel2 and Donata, latterly CEO of If Only Holidays, but more recently he's left If Only and is a non-exec director at two businesses, FlexiReps and Inspire My Holiday. And so Andy's going to be sharing a whole range of subject matter and expertise on things like scaling up, managing through crisis, but quite interestingly, I think, working with travel agents and building a travel agency distribution channel, which again, coming out of this crisis will I think be invaluable to some of the Travel Vault members. So that's coming up on the 12th, and I think Lucy's going to drop a link to register in the chat function there, and I'll give a reminder again at the end. So just, I suppose, by way of context, look, we're recording this on the 29th of October, which I think is terrifying in itself, really. I think if back in March, we'd all thought for a second we'd still be sitting here 7 or 8 months later with still little idea or little visibility on what lies ahead, I think we would have been terrified. The reading, getting a reading on what's going on and what the kind of consumer appetite position, it's really challenging. I think there's little pockets of optimism here and there. Just going back a few days ago, I think we certainly anecdotally were hearing a lot of positivity from our clients off the back of some of those travel corridor changes. So we had Canary Islands going on there, and an opportunity to sell some winter sun destinations really, I think, underscored this idea that there is pent-up demand and there are customers still willing to put money down. But that had already, I think, started to taper off over the last few days, just that initial enthusiasm. And I think today's news with France and Germany going back into like a full-scale national lockdown obviously piles up more pressure onto UK government to do something similar. And, you know, all of this is just really difficult to trade through. I think from a market expectations point of view, very hard to know where we are. I still think we're sort of way off where any of us expected we'd be by this point. I think probably the best indicator, I think, is what the major European airline groups are saying about capacity. They're coming out with a sort of range of planned capacity for the end of this year and the winter season, and that is somewhere around 25 to 40% of their normal capacity, so something like a third of what they would normally expect to carry. And I think, you know, that's the position at the moment is there's just so much uncertainty and really difficult to know when things will start to pick up. Increasingly at TTC, we're talking to businesses about this idea of entering some sort of hibernation state where you can cut everything back to the absolute minimum. And as always, it's this balance between short and long-term measures. What do you do to save things in the short term whilst giving yourself an opportunity to sort of benefit from any sort of long-term recovery? But increasingly, that does look much more focused on full hibernation. And if that means we need to almost restart the business in the future, then that's the way it goes. I suppose the only remaining real sort of area of optimism is probably related to this latest government announcement on job support. And I'll bring Adam in here and he's going to take us through that in a bit more detail. Certainly, after a bit of a false start, the last time round, this latest set of measures does look like it is something that we can work with in the travel industry. But Adam, do you want to sort of take over and walk us through what you're seeing?
Yeah, sure. Thanks, Martin. I'll just share my screen. Certainly welcome changes last week with the Chancellor's announcements in the changes to the job support scheme. From what we've seen, it's certainly very welcomed and has in fact actually reduced some of the decisions that our kind of clients were making around staffs and redundancies going forward. So what I thought would be really useful was just to kind of walk you through those changes and then just try and address some of the questions that we've seen to date. So hopefully you can see my screen. What it is, you've got the scheme has been split into two, essentially. You've got the JSS or job support scheme closed. I'm not going to talk about that too much today. That's really where a business is being forced to close legally by the government, and actually not sure that that's going to be applicable for what we're talking about today. So the other one is JSS Open, and what this does is designed to help businesses that are facing a reduced demand over the winter. So in terms of an overview, the scheme starts on the 1st of November and it's planned to run for what is an initial 6 months to the 30th of April. There is a review scheduled for January. We're not quite sure what that would look like, but could be a potential increase in the minimum hours, I would have thought. There's no link to the job retention scheme. So you don't have to have employees on that scheme. They could, as long as they were employed between, or were on an RTI submission, should I say, up to the 23rd of September, then that's okay. I think one important thing actually, really, and this is from a cash flow perspective, unlike the job retention scheme, what we were doing for a lot of clients is making those claims, which you could do 2 weeks in advance. So the actual grant was received prior to paying staff members. This is now changed. So the first claim is not going to be able to be made until the 8th of December, which actually means that you have to have paid and submitted your RTI submission to HMRC before you can even do your claim. The employee needs to work a minimum of 20% of the usual hours. I'll come on to a bit more about the usual hours in a slide a bit later on. The employer needs to pay 5% of the reference salary. Again, reference salary I'll address a bit later. But that's for the 5% for the hours that are not worked, up to a maximum of £125 per month. The government will then contribute 61.67% for the hours not worked, up to a maximum of 1,541. So what that essentially means is that employees should earn a minimum of 73%, where their usual monthly earnings were 3,125 or less. In terms of who can actually claim, so relatively straightforward for most people, I would imagine. You need to be enrolled for PAYE online, have a UK bank account. As I said earlier, having submitted an RTI with the particular employee on or before the 23rd of September. As I alluded to, what we have seen is some people make redundancies prior to the 23rd of September, but actually if you have done that, you can rehire them after the 23rd of September and get them included on this scheme. So that's quite a helpful clause. And then some or all employees are working reduced hours, but at least 20%. One important point here is you must have a written agreement with the staff. We're not quite sure what that agreement needs to include. What we've seen is clients start to have conversations with employees around kind of general acceptance, and HMRC have said that they'll release further guidance on what needs to be included within those agreements by the end of October. There is a financial test for employers that have more than 250 employees. I won't go into any detail. I'm not sure that that's applicable for most of those on the webinar, but if that is, then happy to kind of answer any questions. But essentially, you need to demonstrate that your turnover has stayed the same or fallen over a period of time. But if you've got fewer than 250 employees, you don't have to be subject to that test. The temporary worker agreement, just in a bit more detail, it must be, as I said, it must be in writing. It needs to be consistent with employment equality and discrimination laws. It has to be available for HMRC to view. You can well imagine that these will be audited at a later date, and they need to be kept for 5 years. And as I said, there are more details coming out at the end of October. So once we have those, then be happy to share. Just in terms of the reference salary and usual hours, so the reference salary would include regular payments, so regular wages, and any non-discretionary payments and commissions. So everything that you were pretty much committed to, anything discretionary would not be included. Then this gets split down. If you've got staff members on a fixed salary, it's the greater of the last pay on or before the 23rd of September versus on or before the 19th of March. If it's a variable salary, it's similar, but it's the average wage between February 20 and the 23rd of September versus the same period in the 1920 tax year. In terms of usual hours, these are only to be used where you've got staff members that are on a variable hour basis, or they've got no fixed hours in their contract. And again, this is similar to the reference salary, but it's looking at the average hours between the 1st of February and the 23rd of September versus the same period in the 1920 tax year, and then taking the higher of those two. Again, there are usually, as we've seen with the job retention scheme, far more detailed examples and calculations that come out, and HMRC at this stage have promised those by the end of October. In terms of what we're seeing, just trying to address some of those questions that we've had already. Training hours, yes, they do contribute to the 20%, but they would need to be paid full pay for doing those hours. One common question, really, and probably the most popular, is around redundancy. What we know to date is that you can't, it doesn't mean that you're committed to keeping those staff members for the 6 months while the scheme runs, but you can't make a claim under the job support scheme for a grant if the employee has been made redundant and is working a notice period. So still gives you a degree of flexibility should you need it, but you won't be able to claim the grant if they are made redundant in that period. So job retention bonus, lots of people prior to this scheme being announced had one eye on the job retention bonus, which, as we know, if you'd had somebody on furlough and you retained those on a minimum wage to the end of January, you would be eligible to claim £1,000 per employee. That still stands, and I think one important thing to mention is that the government's contribution, the 61.67%, does go towards the minimum payment required to be eligible to claim that come 31st of January. There is going to be a publication of all of the companies using the scheme, so you will be published on HMRC's website for using that. Really designed to stop fraudulent activity, so that's out there just to be aware of that, although I'm sure it's not going to be applicable. Dividends, you can, if you're a small employer, you can't. There is no mention that you can't distribute profits as dividends. There is mention for larger employees that they don't expect companies to be making capital distributions, albeit that is not going to be essentially it's not going to be written into the rules, but there is an expectation of the government that those distributions will not be made. National insurance and pension contributions. So as the employer, you will still need to pay national insurance and pension contributions unless the employee has opted out of the pension. But you will also need to pay national insurance on the 61.67% that the government are contributing. So you're fully liable for the employer's NI and pension contributions where applicable. In terms of reduced pay, a question that we've been asked is whereby employers have negotiated in this interim period a reduced salary. Obviously, the guidance thus far mentions a reference salary higher of pay September or March. Could you use a reduced salary as that reference pay? It is implied that you can use a reduced salary if it's part of the agreement, but again, we're waiting for formal guidance from HMRC, so hopefully that comes at the end of October. In terms of holiday, yes, employees still accrue holiday, and if they take holiday in that period, that is paid at full pay. One other question that we've received so far is around other work. So under the job retention scheme, employees were allowed to go away and work for another business to make up their income, which seems perfectly reasonable. It currently isn't in the guidance, but I would expect that should the employees need to go and obtain a second job, then I can't imagine that HMRC would go against that. But hopefully we've got further clarification by the end of the month on that point as well. So that's it just on the job support scheme. One other thing I did want to mention was just around this local restrictions support grant for tier 2 or businesses finding themselves in a tier 2 area. I think the main point here really is going to be around what we'd seen with previous grants that came out back in March, April, May time, that were distributed using local authorities and for businesses that were paying rates essentially. It's going to be distributed using the same mechanisms and is based on rateable value, which I'll cover off in a second. The problem here, I think, is that it's down to the local authority really in their definition of what is hospitality and leisure effectively. What we'd previously seen with grants is that some councils have got different definitions, and therefore some people managed to obtain the grant, whereas other people unfortunately missed out. So this is if your business is in a tier 2 area and you've got your local authority, then what I would urge you to do is really check the local authority website and speak to them if you can, to find out what their definition is and how you can apply. I would expect that to be coming out in the next week or so. This scheme is running from 1 November to the 30th of April 21 as well, again with a review in January. If you do meet the definition under your local authority, what you could potentially get is the following. So again, based on rateable value, if the building you're in has a rateable value of 15,000 or under, you could potentially get £934 per month. With a rateable value between 15 and 51k, it's £1,500 per month. And if you've got a rateable value of over 51k, you could potentially receive £2,100 per month. If you've already looked at the tier 3 grant, what you'll notice is this is 70% of that. But again, tier 3, I'm not sure would be that applicable. Potentially if you've got a shop and that is forced to close, but I don't think under the current tier 3 guidelines, a shop would be forced to close under tier 3, but these things tend to change on a daily and weekly basis. So, well, yeah, as I said, all I would urge is that you check the local authority and see what their definition is, and speak to them if you can. And that's the update from me, Martin. Happy to take any questions.
Great, thanks for that, Adam. And just a quick plug there, I could see on the screen, and I know TTC have put out a few little kind of infographics and worked examples and things on both on their website, on LinkedIn. So if you're not already following that, I would encourage you to get involved, because some of that stuff might just help answer some of these questions. Adam, there are a couple of technical questions on the Q&A function there, which we can pick up in a second. I suppose before we get to them, just my overall perception of this is it's a lot better than it was than the previous scheme was, but there's still a bit of a cash flow burden on companies, right? The idea is, I guess, you have to fund a lot of this payment up front before you claim it back.
Yeah, it's we often hear the words U-turn. I liken this more to a 3-point turn in your driving test, where we seem to be getting there, but not quite fully back to the job retention scheme, which I do understand. As I said, it is certainly on the ground. It's been very welcome and has reversed a lot of decisions that we'd seen with some of the clients that we work with. So certainly keeping people, in the Chancellor's words, in viable jobs. These, as we've seen some pent-up demand, these jobs, will be viable certainly, but we just need to get to that point where travel is kind of the demand is actually able to fly, essentially. So, although not quite as helpful as a job retention scheme, certainly much more helpful than it was a few weeks ago.
Yeah. And it'd be good to get Steve's view in a second on this as well. But just before we jump to that, shall we just run through? There's a few questions on here. There may well be the short answer may well be we don't know yet, and the full advice isn't out, because I think the initial statement is usually supplemented by some follow-up guidance. But just sort of working through them. There's a question here about new contracts that were issued back in September, setting out revised days of the week. We're obviously now in a situation where the entitlement now is based on contractual terms. Do you know, can we refer back to that original contract in terms of the numbers of hours that they were contracted to when we're making the claim?
Yeah, there is going to be, you will need what is called a temporary written agreement for essentially a temporary contract that needs to cover at least 7 days. One thing I didn't mention in my presentation, but you can have different working patterns. So you don't have to have an agreement that essentially sets out the next 6 months. It can be adjusted. So whilst I don't see why you couldn't refer back to that and include it in a temporary written agreement, I'd await just the further guidance to clarify that point.
Yeah, okay. Second question on there is around, I guess, taking holiday during that period that you're on reduced hours. My understanding is the holiday would be prorated down to the level of reduced hours, but I don't know if you think something different on that.
Yeah, awaiting detailed guidance, but if it's, I would imagine it'd be prorated under this temporary agreement. But again, any holiday would be paid using the reference salary. Yeah,
fine. And then the final question is around holiday pay and the how that will be picked up through this. Will the government's percentage apply to the holiday pay as well, or will that be 100% picked up by the company?
I believe at this stage it will be picked up by the company. But again, that should be clarified in the further guidance.
Yeah, great. Look, I know there's the Travel Vault newsletter goes out regularly, and so as and when we get more guidance on this stuff, I guess we can prepare something or signpost to the more detailed guidance, and hopefully that will answer some of those questions. Can we bring Steve in? And just, Steve, it would be great to get your view on how these latest job support announcements are affecting the sort of work that you're doing, and if that's not a bit sort of the backward way of doing it, we'll then explain a bit more about what you do for a living.
Yeah, sure. Well,
Having heard what Adam just said there, would you sort of share his view on that?
Yeah, I mean, I think if I was to roll back a couple of months, everybody was looking at the roll off of the furlough scheme and thinking that could be the start of a flood of real distress around the market. And on a day where we've seen all over the papers the number of HR1 forms that have been submitted to government and likely redundancies over 20, I think you can only look at this and say it's good news. And I think it is making a difference, because the level of insolvencies, whilst it picked up in September slightly, it's still way down on where it was this time last year. So it's positive news, and I think it, in a difficult environment when most things seem to be going backwards, it's just having this type of support mechanism in place is good, and I think it gives people breathing room, right, to figure out really what it's going to look like over the next 3 to 6 months. Granted, there's a huge amount of uncertainty around that.
Yes. Yeah, look, we talked on here plenty of times about there will at some point in the future be plenty of demand for the products, and it's all about just lasting for as long as it takes for that demand to come back, isn't it? And so certainly anything that helps is good news. But I mean, just before we get into the details, Steve, it'd be good just to take a step back, and if you wouldn't mind just outlining for us, just to give us a bit of a flavour for the sort of work you do in the restructuring team, and what kind of services that PwC team provides.
Yeah, sure. So I'm a partner in the restructuring team at PwC. We're about 40 partners across the business, and we do a real broad range of things, but everything from distressed financial restructuring and insolvency right through to operational restructuring and solvent restructuring. So it's a very broad business. I tend to focus on solvent restructuring, managed exits, and a bit of distressed work. So kind of a hybrid across those, and that's where I've spent most of my career. And if I think about how we're trying to support businesses at the moment, it's all about saying kind of we're in the eye of the storm, right? And we need to do things now to just prepare and give yourself optionality for the future. So we kind of a lot of that is focused on, well, what does your current operational base look like? Your cost base, and therefore what can you do right now? And you're talking about mothballing businesses. I mean, we really saw that in March. I mean, there was people reacted really, really quickly. And I think, we sit here, as you say, I can't believe it's the end of October. And it's almost more difficult now because it's stop, start, and people don't quite know whether to commit or not. And so I think having a real clear view about what you can do and when you can do it, and then just doing it, I think is really important. And we're speaking to lots of businesses that are writing forecasts, and then next week the forecast looks completely different because the circumstances have changed. And so, having a robust forecast in place that's dynamic, so you can change it and you can flex it, and having those mechanisms that you can pull if you need to, I think is really, really important. So we're doing a lot around kind of operational and setup and mitigations, in the event that things don't work out as they're planned. We're doing quite a lot around cash and liquidity, as you'd expect. So not only just the basics of making sure that you've got a proper cash flow monitoring tool in place and that you're using it, but actually just trying to embed that through the business. So everybody from start to finish is actually looking at cash, and typically people don't, right? They look at their bit, so it's sales driven, but just really embedding that cash piece. And around the travel sector, where I've seen that over the last few months, it's really just trying to say, well, it's how do I get money back from suppliers who cancelled holidays and get it back to customers, quite frankly, or when we are getting customer money in, what are we going to do with it, and how do we work with our suppliers and our partners to try and give us some space, because quite frankly everybody's in the same position. There's a whole piece around stakeholder management at the moment. In any restructuring situation, quite frankly, talking to your stakeholders on a regular basis is important. Being consistent, so that you don't just disappear. And the worst case is people disappear, and then people see shadows, and it kind of escalates. So talking to people, and quite frankly, where we stand today, I think you can be really honest with people, because I think everybody's facing the same challenges, and everybody's just trying to work out, well, how can I get through this? And so there is an element of people pulling together.
That's always the real nervousness, isn't it? Because I think there's that feeling that you don't want to signal, you don't want anyone to, rumours to start, almost by having conversation with one creditor that there's a problem, maybe starts to become a self-fulfilling thing. I mean, is your advice that current situation is you've just got to grasp the nettle on that stuff?
Yeah, absolutely. And I think be upfront with people, but be consistent as well. So it's your protection as a director of a business that you're treating everybody in a consistent way. But I think all of your people talk, right? So to the extent that you try, there's a different message for one group versus another, people will find out, and it just undermines anything you're trying to do. So yeah, I would always say, be clear and be prepared about what you're going to say, but don't delay. Just go and have those conversations. And actually there's lots of support mechanisms around, and so those conversations tend to be more productive. And look, the situation changes, providing you keep people, and that goes to everybody, right? Just as important to employees as it is to your sponsors and your banks and all of your customers and suppliers. So just being on the front foot around that, I think, is really, really important. And I see that on the other side as well, when it goes wrong, when people say, well, hold on a minute, you led me down a garden path here, and we were never trying to, there was never an answer. And the reality is, well, providing you're giving everybody consistent messages, you can say that genuinely everybody was trying to get through it at the same place. So I would say, be on the front foot with your stakeholders. And if I was to think about, I work across sectors, so I don't specialize in travel, but inevitably I've been spending a bit of time in travel over the last few months, and I think I've actually seen a really supportive sponsor group of the businesses I've looked at, where they are getting behind their businesses and they are trying to support it, recognizing for exactly, there is a product here, it will come back. God, don't we all want to go on holiday more than ever before? We just got to try and bridge it to get there. And so talking to your stakeholders. And then I think probably the final piece of that is just being aware of the options and the mechanisms that are available. So I think of what you've just described, Martin, mothballing the business, right through to transactions, right through to, quite frankly, insolvency mechanisms if you need to go down that route. But lots of different options available, and I think just being clear, using the time now to plan for those things and knowing when you might have to do them, I think is really, really important.
Yeah. Just on that stakeholder piece, and particularly thinking about lenders, I mean, Adam, does that chime with your view as well? Because obviously we speak to lenders in respect of a whole range of travel companies, from very small to very large, and it often feels like there's a different approach from banks. I mean, just speaking to a bank the other day, they were really saying all the right things about that sort of supportive environment, but I don't always feel for smaller businesses we get the same sort of approach. Would you agree, Adam?
I think it's pot luck in some in some it really depends on from my experience, certainly over the past 6 months, if you've got a good relationship manager, for example, to take CBILS or Bounce Back, which will a lot of clients have gone with. If you've had a relationship manager in place, and a good one, you've often they've been very accepting and supportive, as Steve said, and therefore that has resulted in a success in that respect. Whereas if you don't, or you don't have one at all, then it's been a lot more difficult. Although in the public eye, the banks and lenders seem to be supportive. Whether it's just circumstance or at the bank itself, we know they're inundated, but you certainly haven't got that same level of support in that respect.
Yeah. And I would distinguish actually between sponsors and banks, because I think sponsors have been particularly, in my experience so far, I think I've seen sponsors being particularly supportive. Lenders, I think, are a little bit more timid. I mean, I have seen them put new money into situations and facilities to help businesses through, cash flow tests and things like that. But I think what I've been most impressed with actually has been equity cures. It's been sponsor cures that are putting most of the money in. And I guess because the reality is, taking on a load more debt is just storing up a problem for the future. And if you read any of the surveys they've done around the amount of money that's been put out the door through the likes of the CBILS and the questioning the practical reality is our business is going to be able to service that in the future. We are in a low interest environment, but still there's an incredible amount of debt built up on the corporate balance sheet now that I think there's growing skepticism about how that will be paid back.
I think you see that, and you certainly imagine these banks are recruiting armies of recovery people to support them in that when the inevitable sort of backlash arrives.
Yeah, I mean, I think they all have. I mean, if I think about the conversations we're having over the summer, all restructuring teams at banks have tooled up massively in terms of the capacity they've got within the team. But I don't think they've seen that really come to fruition yet. I think there's still a lot which is sat with the front office, and being kind of pushed down the road a bit. So yeah, not saying that won't happen, but I don't think we've seen that wave hit the restructuring teams at the banks just yet.
Yeah, I mean, all that being said, and I definitely can see that we are maybe sleepwalking into a sort of leverage crisis further down the line. But what advice would you give? I mean, I can think of businesses, certainly TTC clients and maybe some Travel Vault members as well, who were quite quick out of the blocks early on when these government support schemes were announced. But that was all based on a modelling and forecasting of a world view back in April or May, which were clearly way off target now. Yeah. And so conceivably, a lot of those businesses need to go back and have even another conversation with the lender. We still have roughly a month left in the CBILS environment. I mean, do you think it's worth, in your experience, are you seeing lenders willing to come back and have another sort of go at a restructuring so quickly after the first round, or is that not?
I haven't seen them come back so quickly. No, I think you need to get to a point where we've got a bit more clarity than I think we've got at the moment, and it's still so hard to predict. So unless you're forced to, I think that's not a here and now conversation so quickly afterwards. That's not to say. I mean, I have heard with some changes around CBILS application to private equity-backed businesses, there's been a bit of noise around actually whether that's opened up an opportunity for some, but I haven't seen an awful lot of that turn to fruition. But it's not really my part of the business. But what I would say though is I think people need to be pragmatic, right? We are in it, best intentions back in March. We're in a different place today. I think it would be a bad situation if everybody suddenly went, "Oh, we're all in a different place." Throw the keys in, or so I think I hope that people would be pragmatic, but I think we just need to give that a bit of time, and hopefully if we can just keep bridging, we'll be able to start to see the fruits at some point, and then people can start the hard work about trying to restructure some of these debts.
Just going back to, you made a comment there about directors, the directors' duties when from the point of view of treating creditors fairly and even-handedly. I mean, are there any other sort of areas, I guess that we'll have a whole range of levels of experience on the call here in terms of how a kind of process works, what the director's responsibilities are as directors of a limited company. I mean, what are the sort of key things that people should be aware of when you're, not to say that you're needing to call in an insolvency practitioner yet, clearly you could be sort of way before that, but what sort of things should you start to be doing just to manage your reputation and that sort of thing?
I mean, there was a temporary change to the insolvency legislation around directors' liability around trading whilst or wrongful trading whilst insolvent, which expired at the end of September, and that really made a difference for directors that will be worried about the personal liability of incurring debts during that time. I think, in an environment that we're in, we'd expect everybody to be doing the basics and having clear and regular conversations around their financial position. There's very few businesses that won't be in a position like that, and therefore that would mean having regular board meetings that are minuted on a real-time basis, so that it all about kind of having that look-back test that you were making decisions that were reasonable at the time. Having up-to-date information, so having a cash flow forecast, having an up-to-date creditors list, the things that you need to be trying to test yourself on, and particularly this as you get more into distress situations, is there a reasonable prospect of me avoiding insolvency? And if you can't answer that question, then you do you then do start to run the risk of trading whilst insolvency. So that's kind of one thing to have in the back of your mind. And then the other thing is making sure that you treat everybody fairly. So you're not treating one creditor over another. So running a proper creditors list, and checking that on a weekly and a monthly basis to say, well, what's the position today of X supplier versus what it is in a month's time? Have I made their position worse vis-a-vis others? So, I mean, there's protections that you can put yourself as a director in a situation that is distressed, that just makes it, if somebody comes in and challenges you that you should have made a different decision at that time, you've got the evidence to say, well, look, based on the fact pattern at that time, I made this judgment and that was a good judgment. And that's, I mean, I noticed at the start of this call, you made the point, it's the 29th of October, because I think if anybody's watching this back in, a month's time, they might go, what were we talking about? It's a completely different situation. So yeah, I think just look at that, because that's the way somebody will look at it in the future when they're coming to look at what went on with the business.
Yeah, all of this is changing so rapidly, isn't it? And again, I mean, you made a point earlier that we've been consistently on this call and on other calls talking about this cliff edge, which at the time we always talked about end of September felt like this watershed. And I can't quite decide if maybe I was wrong and actually maybe the sector is generally better capitalized, or if actually it's a bit like, Wile E. Coyote's run off the edge of the cliff and is now sort of running in midair and doesn't realize they've fallen yet. Like it feels like we should have seen more insolvencies. I mean, what do you put that down to? Does it normally lag the recession? Is it something that's coming and it's just a case of these schemes are kind of helping prop people up? What do you put it down to?
I think, yeah, so definitely the schemes that have been put in place. So the job support scheme, big costs for particularly travel businesses are, people. So that's made a big difference. I think up until the end of September, the protection for directors helped. Although that's fallen away, the temporary measure that they also introduced to delay winding up petitions, I think is helpful. So actually, as a creditor, you've got limited options if you're not getting paid, quite frankly now. So, that gives people breathing space, and that's expired. That runs till the end of December this year. And then actually, if you look at there was a lot of changes to the insolvency legislation over the summer to bringing things, I'm going into lots of detail, but they brought in three things: a restructuring plan, a moratorium, and then changes to the ipso facto clauses, so automatic terminations on insolvency. All of these are designed to create a kind of an environment where a restructure is more possible, rather than kind of forcing companies down into insolvency. So I think the environment is right to get as much protection as we can. And as I said, interest rates are very low. There's quite a lot of liquidity in the markets, but a lot of people are talking about this will be a deals-led recovery, because actually there is money out there. It's just about putting it to work at the right time. So that's probably as good as an environment as we're going to get. I still come back to, businesses have taken on a lot of debt and that needs fixing. So what I think we all hope is that it gets to a point where maybe there is, if there is some sort of restructuring required, it's balance sheet led, and actually the business has picked back up again at a point in the future, rather than, if you model the scenarios out, and it'll touch different sectors in different ways, but the long-term lag for certain businesses. So in travel, I think there's some concerns about structural changes around business travel, for instance. If you play in that market, then I think there is some real operational challenges that you're going to have to kind of right size your business for the future. Compared that to more kind of short haul, and we've seen some real optimism, the pent up demand argument that says that could bounce back quite quickly. So I think it's really hard to judge. And insolvency, there will be a bit of a lag. We will see a growth of insolvency. That's inevitable. But I think all of those things put together actually have created an environment that's quite supportive for corporates at the moment.
Yeah, interesting. Well, one thing we often see as a real sort of barrier to this ideal, that is the idea that it is a deal-led recovery, is the regulatory position. Actually, going through a few processes that we've worked on so far, it feels like mainly the CAA. I think ABTA has a part, IATA have a part, but mainly the CAA don't seem willing to give anyone an easy pass when it comes to putting some business combination together. You know, they're looking for equity injections on the day of completion, or the deal doesn't go ahead, and they seem very willing to play a kind of brinkmanship game. I mean, I don't know. Fleetway Travel is obviously one of the recent insolvencies you've worked with, and you know, maybe you might not be able to sort of share too many details of that. But would you have you sort of come across that as a stumbling block where you're sort of working through? Is there a pre-pack, or is there a sort of option around selling assets in an insolvency that's caused a problem?
Well, I mean, Fleetway, they did the transaction. It was just really, unfortunate timing. So they had just done a transaction to acquire another business. So they were on their turnaround journey. And I think, therefore, when COVID hit, they probably weren't in the best position. They're probably in the best position they've been for some time, but weren't in the best position. So, to be honest, they did everything that you'd expect them to do, and they got control very quickly when it all happened in March. They just fundamentally couldn't raise the money. So I think that was just unfortunate timing. I think the regulator has a tough job at the moment because everyone's got red alert, lots of risk. Their role is to protect consumers, and at the same time, the fundamental principles of restructuring are that everybody contributes something, and so when sponsors are putting money in and lenders are putting money in, and staff are taking pay cuts and execs are, everybody's contributing something. You sort of like to think that the regulator would also say, well, we'll give something, and I've seen a degree of pragmatism around that, but I haven't had a direct experience where we've been going through a transaction with the regulator yet where they've kind of put brakes on that. I have some sympathy that I think they've got a tough job to do.
Yes. Adam, are you seeing much around the sort of equity injection piece? Shareholders or owners of clients. Again, it feels like ultimately that's what it's going to need to redress the sort of leverage balance is some equity going in. But at this point, it doesn't feel like there's a queue of people willing to throw them in the industry. What they're looking for is deals and sort of cut price acquisitions, right?
Yeah, back in March, you had some kind of, I guess, investors circling around and looking for opportunities, but then realization quickly kicked in. Some of the typical investors we speak to said, well, let's hold off till September and see where the market lies. I think that's been kicked back even further now, I would have thought. So from an external stakeholder perspective, I've not personally seen any injections so far. Certainly, willingness from owner managers to contribute, whether that's from injecting their own cash or doing certain things to help the business survive. They're certainly willing to do what they need to do to get across this bridge, but unknowing where that bridge ends really, and the demand starts to kick in, that seems to be the real problem. So certainly looking to contribute and do what they can, but it's quite limited, I would say.
Yeah. On the creditor management side, Steve, just going back to that, something we read a lot about is CVAs tend to be more weighted towards, I think, the larger businesses, and particularly businesses with a big retail footprint. But I mean, there are some of those in travel, and certainly a handful of Travel Vault members who maybe would fall into that category. And what's your view on them as a sort of tool?
They've been a very popular tool over the last couple of years, particularly around retail, and particularly around managing a landlord exposure. Therein lies the controversy. Are you identifying one group of creditors over another? And undoubtedly, I think the history has been yes, and I think there has been some history of them not being particularly successful. So I think as we would often say, CVAs have got a place, but they need to be part of a broader restructuring practice, restructuring plan. So, that's other operational restructuring to make sure that the cost base is properly aligned, a proper funding plan, equity, debt, all of those things together. And I think there has been a history of them not really doing that. I think as we sit here today, more and more you're seeing better CVAs that I think is listening to the market and the challenge that you're hearing from particularly from landlord groups around their exposure. So I think that they have a place, and I think that will continue to be a big aspect of the restructuring market for the next the next year or two. I mean, they came into their own a few years ago and kind of died off a bit, and they've come back again with aplomb. And I think that's for lots of reasons, but primarily around the change of the retail high streets, and therefore large store portfolio. So I think probably applies equally to certain travel businesses as retail, pure play retail. In my experience, actually, I would say, do you really need to go through a CVA, or can you just go and have a conversation with landlords? Because quite frankly, if you can negotiate compromise positions on a bilateral basis with your landlords, then that's better, because it avoids the cost of a process, the public eye. And I think we're hearing more and more that landlords are sat there saying, I don't really want to go through a CVA. I'd much prefer to have a conversation with you, because as soon as it goes into a CVA, it's in the public domain. Everybody on the high street knows that that shop next door has just got this discount because of the CVA, and therefore they want the same. So they're much more open to doing deals outside of that formal public process.
Yeah, we've certainly seen that especially with private landlords. Definitely a willingness to support. Some of them, incredibly supportive and kicking the can down the road for a lot of people, or giving discounts for quite some time, which is very encouraging. Then we've seen with some of the bigger landlords that run big serviced offices, they don't seem to be as willing to help out the kind of smaller players, if you like. So they're generally some have been enforced the terms that they've got, so that's unhelpful in some situations.
Right. I mean, if it just conscious we're coming up on time, so we'll sort of wrap up with some final thoughts. But I think that on that point, Steve, are there any tips you would offer, or any sorts of recommendations for the way to approach not just landlords, but any particular creditor group? What's the sort of minimum people should have in their armory? What should they be kind of preparing in advance of those discussions, would you say?
Yeah, I would have a robust set of financial forecasts that you're prepared to share, and I would keep some flexibility around base case, downside case, and just make it realistic. I would be absolutely making sure that you're treating everybody fairly and in a consistent way. I'm very alive to the fact that Crown Preference comes in from December, so if people are accruing HMRC debts, they will jump ahead of the crew. And so thinking about actually there's a position today in keeping everybody consistently paid, but in the event of failure, what happens? All of a sudden the revenue are going to be in a better position than others. So thinking about kind of what the outcome could be for stakeholders. So what we've seen, and for any decent restructuring, you'll see is some counterfactual analysis that says, well, I'm offering you X. I mean, some of the payment terms that they got for trade creditors on the Virgin situation were quite long, but they were able to show that compared to an insolvency situation, you're fourfold better in terms of your outcome. So I would just get as much information as you can, talk to them regularly, and if you promise to do something, do it.
Yeah. Adam, final thoughts from you? Anything you'd add?
From what we've seen, certainly the cash flow is the biggest one where we're involved at the moment. As Steve said, looking at various scenarios, but as things change, making sure that they're up to date. It might be that you thought balances were coming in for December, but maybe they're not. So it's keeping an eye on that, really, and being as realistic as possible.
Yeah, that dynamic model that you talked about, I think that's something that we sort of bang on about time and time again. It's not about who's got the better crystal ball. It's about who's got the mechanics to be able to quickly update the position and understand where the pitfalls are and what levers can be pulled.
Yeah, agility is the key there.
Yeah. Just in the nick of time, we've had a question come through, so let me just have a look at this. What's your view on companies that are going into insolvency, then restarting as a new company, and how are the CAA treating those, e.g. Thomas Cook? Well, look, I'll give my sort of quick start for 10 on that. I think historically those sorts of Phoenix arrangements have been really difficult to get away from a regulatory position, because CAA have two big tests that they look at. One is financial and one is the fitness aspect. So you've got to work quite hard to demonstrate that, having been a director of, say, a failed business, you acted properly. And it's quite hard to sometimes prove that negative. It's quite hard to prove that you didn't do anything wrong, if that makes sense. There might be a weight of evidence if you did do something wrong, but not necessarily the other way around. So it has often been hard, but I think these times are unprecedented. Funnily enough, I had a call this morning with the CAA about exactly this, and they left me in no doubt that they would not welcome an application from this particular license holder that had previously failed. But Thomas Cook, I guess, is a bit different because the owners of that are different, even though the brand name is the same and some of the senior managers are the same. So I think short answer is it remains to be seen, but it's not easy. Steve, I don't know if you agree with that.
I would just add, it's always difficult when, if a business fails and then it comes back to life, and I think as an insolvency practitioner, I would always say, look, it's incumbent on me to get the best possible outcome as I can for creditors at each point in time, and therefore that does often mean trying to sell a business, sell a brand, transfer people so that they can continue to have employment, etc., etc. And inevitably, though, the cost of that is some people get left behind. There is particular focus around when it's sold back to connected parties, and the Phoenix element, Martin, that you talked about, and there are changes afoot around trying to make sure that there is some mandatory consultation around those. So there was an introduction of a pre-pack pool to try and give people confidence that in the event of transactions back to connected parties, they were properly diligenced, and it was in the interest of creditors. That has had relatively limited success. It's not a well-utilised pool, and the legislation that's being consulted on it at the moment suggests that something equivalent will be mandatory. And I think anything that gives people confidence that that was done with the best intention is welcome. I mean, there's already things like SIP 16 where you have to fully disclose marketing, how you demonstrate value, etc. But I think anything that gives people confidence is welcome, quite frankly.
Yeah, it's certainly something I think we'll see more of over the next months. But there we go. Well, look, we're just up on time there. Unless anyone's got any sort of final thoughts, we'll wrap it up. But listen, thanks for both for joining us. Thanks, Steve. Thanks, Adam. Thanks, Lucy, for keeping me on the straight and narrow. Just a quick final plug for the next webinar on the 12th of November. The link is in the chat function there, so you can register for that. I think we'll follow up with a Travel Vault newsletter with a link to this video, but also a link to that other event, and certainly any follow-up information on the job support scheme as and when it comes through. But otherwise, thanks everyone. Have a good afternoon.